8 straight weeks. S&P 500 gains. The longest winning streak since 2023. This just happened, and most investors don't realize what it means yet. Here's what's really going on, and what you should be thinking about right now. The S&P 500 is on the verge of its 8th consecutive weekly gain. 8. That hasn't happened since 2023. The Dow just hit an all-time high. Not a multi-month high. An all-time high. That's real money moving with real conviction. Today, Kevin Warsh was sworn in as the new Federal Reserve Chair. The most powerful financial seat in the world just changed hands. And the previous Fed minutes? They revealed something critical. A majority of Fed officials were already embracing the possibility of higher interest rates. Higher, not lower. That means the rate environment you've been planning around. It just got a lot less certain. Yet markets are rallying anyway. The S&P 500 doesn't care. The Dow doesn't care. Capital is moving. And it's moving up. Here's the question every serious investor needs to answer right now. Is this rally built on fundamentals? Or is it running on the adrenaline of a leadership change at the Fed? But here's what nobody is saying about this yet. Markets aren't rallying despite the Fed uncertainty. They may be rallying because of it. Warsh's arrival creates a reset, a clean slate on rate expectations. And Wall Street is front-running the narrative before Warsh has said a single word as chair. That's how fast money moves. That's how dangerous assumptions get priced in. Warsh has a reputation. He's historically been more hawkish than Powell. If he signals even a slight lean toward tighter policy in his first public statement, rate-sensitive sectors like real estate and utilities could reprice fast-growth stocks and long-duration bonds even faster. This is the gap between what markets are pricing in right now and what may actually be coming. First, watch Warsh's initial public statements like a hawk. His word choices on inflation and employment will move markets within minutes. Second, reassess your rate-sensitive exposure right now. Real estate, utilities, long-duration treasuries. All of these are vulnerable if a hawkish pivot materializes faster than consensus expects. Third, understand your growth stock duration risk. Higher for longer rates compress future earnings multiples. If you're heavy in high multiple tech, that math changes fast under a hawkish Fed chair. 8 consecutive weeks of gains. A new Fed chair sworn in today. All-time highs on the Dow. This is a pivotal moment. And your next move matters. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor.